Yeah. Hello everyone, this is Manish Chauhan from JagoInvestor.com. We have just logged in to the webinar. So hi everyone, this is Manish Chauhan from JagoInvestor.com. We have just logged into the webinar. So just give us like 2 to 3 minutes to set up everything. Just 2 to 3 minutes. So I want to first ask, is everyone able to listen to me? Can you just write on the chat section that you guys are able to hear me? Just write down, yes, I can hear you, so that we know that, you are able to listen to me. I'm running a poll, just answer it with yes or no. Just give us like 2 more minutes, guys. We'll just start. Let some more people join in, and then we'll start. For those who are not able for those who are having audio issues, please use your hand mics. You'll be able to listen properly. We'll start in 2 minutes. We'll just wait for some more people to join, and then we are starting in 2 minutes. Just keep patience. So we'll be sharing the screen. We'll run the presentation. So you'll be able to see the presentation and hear the audio. So this is how it's gonna work. Okay. Okay, so I think most of the people are able to listen the audio properly. I just saw the poll results and looks like around 95% people are able to listen to the audio clearly. Okay, so now we are going to start the webinar. So hello everyone, this is Manish Chauhan. I would like to welcome you all to this first webinar by JagoInvestor. We wanted to do these kind of online classrooms from a very long time, and now it's going to be a regular thing as part of our JagoInvestor School initiative, which was launched some days back. I'll share more about the school later with you all in case you are not aware about it. So now I want to talk about the topic today. The topic today is it right time to invest in equities? So let me first share what all things you are going to see today in this webinar. So we'll see some old and historical market trends in last 20-30 years. The second thing we'll see is various bear and bull cycles discussions. The third thing will listen to will be returns from the markets in the long term, and we'll also see equities versus real estate discussion. So these is the very high level agenda of today's topic. Now let me introduce you to our speaker today, which is Mr. Nooresh Merani. Now, Nooresh is a full-time technical analyst and he has experience of more than 10 years in equity markets. Nooresh also appears on several channels like CNBC, ET Now, even Bloomberg, and he has seen various bear and bull markets, and he has very vast experience in equity markets. Now, I think he's the perfect person to talk about markets, and we really want to thank him uh, because he accepted our invitation to do this webinar on this topic. Me and Nandish, we have personally known Nooresh from last 8 to 9 years, and I can assure you that he is one of the best speakers on this topic, as we have seen his passion in this area. We have seen his workshops. Even he has come to our workshop, and he has done a lot of seminars, and he keeps on doing lots of seminars and workshops on equity markets across India. So I think he's the best person to talk on this topic. Now, one thing I want to mention is that there are a lot of equity analysts out there in the market, but we thought that let's bring in Nooresh to present this topic, because we think he's the best person to talk on this topic, because we are very confident about his domain knowledge. I've talked to him several times, and I'm really amazed by his knowledge and his way of thinking on markets. So now, before I hand over this presentation to Nooresh, I want to talk about one very important point, that this is our first webinar and this whole thing is a little new to us. So I request everyone who is attending this webinar to keep patience. In case we run in with any technical difficulty, please cooperate if things are not working out. So let me now share how this will work for the next 1 or 1.5 hours. So for the first 1 hour, Nooresh will be presenting the webinar. And in case you have any questions, please keep your questions till the end, like for the end. We will not take the questions in the middle, because we want to concentrate on the presentation in the start. At the end, we will have a quick Q&A session where Nooresh will take some questions and answer them. So with this, I think I would like to hand over this webinar to Nooresh, and he will take over this from here. So Nooresh, over to you. You can take it from here, and you can start the presentation now.
All right. Good morning, everyone. So maybe the video will not be very clear, but the audio should be fine. There could be a little lag. So within few seconds, you'll be able to catch it up. So this will be a session for 1 hour, wherein I'll be running you through a presentation on is it the right time to buy equities, and post that we'll take Q&A. So what happens is that during the 1 hour, please do not put up anything on the chat. I might not be able to see it. So let me start up with the presentation, and thanks Manish for your kind words. I've known Manish since a long time, and he's been one of the few guys who can actually talk on financial planning in a very clear way. So let us look ahead as to, let me share my presentation with you all. All right, so I believe everyone can see the presentation now. I would just say if it is, I hope the presentation is very clear. You can see the desktop at, is it the right time to invest in equities? All right. So let me start off with it. So the topic today is it the right time to invest in equities? And if there is any issue, I would say Manish will be looking onto the chat. And if there is a problem, he'll call me up. So I'll start the presentation. So now, when we go into equities, now there are a few questions which we need to get answers for. So the very first question is CAGR returns of Indian markets. Now this is a very tricky topic because all AMCs would talk about it to be 16-17%, which is not, and we'll look into it later part of the session. Inflation is at 10%. WPI could be at negative. How much should you expect from equities and or any other asset? So this is one of the questions which we'll try to answer. Third one is, should you buy direct equities or mutual funds, ETFs or ULIPs? So this is a question which Manish should be able to answer really well. I'll be focusing on say direct equities and mutual funds in a simpler way. Then one of the very most important topic which people like to sell is time in the market is more important than timing the market. So we'll see to it that what is more important by end of the session. What is the long-term outlook of Indian equity markets? And the final and the most important thing which people need to look into is, should real estate and FD be 99.5% of your net worth? So these are some of the questions which come up when we are talking about equities. So I think the presentation is on full screen only. So I'll just a second, I'll do something. All right, I believe now it should be full screen. Was this full screen for everyone? Now is it fine? Right. So I've put it to full screen. There was a mistake on my end. Sorry for that. So now we again go to the questions quickly. I think now it is on full screen for everyone. Great. So there would be a little bit of blurring and say a bit of lag given the internet connection for everyone involved in it. So equities and questions very quickly. CAGR returns of Indian markets. Inflation at 10%. WPI could be lower in negative territory also, but roughly inflation has been around in the double digits for India. Should you buy direct equities or mutual funds, ETFs? So this is again will take. Time in the market is important or timing the market is important. This is a very tricky question, and this is what I'll be taking more importantly. That would be one of the focus areas of the presentation. What is the long-term outlook of Indian equity markets? And the last one, which is a major pain for everyone out here, wherein real estate and FD should be 99% of your net worth or not. Okay, so next we go to one of the major things which everybody talks about across the industry. Indian equities, 17% CAGR for 35 years. And then comes the part, please buy mutual funds, ETFs and ULIPs. So this has been the total selling point, that Indian equities have returned 16-17% CAGR over 35 years. Now that is a superb CAGR. Please buy mutual funds, ETFs and ULIPs. Don't buy ULIPs is the last point of it. Then you will start answering why FD. I'll tell my wife not to buy gold. Now this is now at 15 to 15.5% over the last 36-37 years after the current correction. Then one more point which everyone loves to sell is be passive, don't learn. So most of the times you'll hear about direct equities is risky. Mid cap stocks, small cap stocks are operated. Small cap stocks are junk, penny stocks. Only mutual funds or ETFs are best. Why learn, be passive, enjoy? So what we've created a structure is make people buy mutual funds and ETFs. Do not go over direct stocks. Forget about timing, even the entries of mutual funds. And this is what has been the easiest way also for a majority of the investors, I would say. But you not implement your learnings, but it is good to learn about market conditions. So when you say something like this, so people start talking about their losers. So people generally end up buying stocks which are in the news. So Suzlon ki to hawa phus ho gayi types jokes come up. Then I have Shri Ashtavinayak, and real estate is the real value. There is something tangible you can see every day. So learning has been a major problem. Nobody wants to learn about equities. Even though people, those who are into equities for a long time, not really like learning it or increasing their knowledge about it. Right. So this is the problem about not learning. So another misconception which majority of Indians, or I would say people those who love real estate, not really Indians, but majority of the people have this real estate doubles in 3 to 5 years, 7 years. So people love this part and everyone. So yesterday I was at a dinner with a few friends and the discussion ended up with how a friend is looking out for a house, and it has been a painful process. Luckily he has not bought one and decided not to. So this is what happens. This 2 BHK flat is cheap at 2 crores. Maybe I'm talking about Mumbai. It would be cheaper otherwise. It will double in next 3 years, 20% down payment. So generally, without looking into finance, one just chuckles up to the fact just EMI. Because generally people do have savings of 10 to 20% as down payment many a times. So, and there you go into the EMI struggle, which is for 20 years, 30 years, maybe someday they'll get a 40-year loan also. So this has been the traditional way of investments for a lot of people. Buy real estate, buy loans, spend money, and if you have money left, make some FDs and buy some gold. For some fun, trade equities. For more thrill, trade derivatives. This is how I'll sum up the investment strategy for quite a lot of people. And when I say quite a lot of people is because only 2 to 3% of Indians invest into equity. So I can actually use these words for a lot of people. Maybe the current set of people, those who are there on the webinar, are not out of that 97%. They're in the part of the next 3%. All right. So I think there is a little bit of a problem on visuals. It could be at a connection problem at my end as well as at your end. So maybe even the audio would be very clear. So there is not a lot of it on the visuals. So on the PowerPoint, whatever is there, I'll be talking about it. So it should be clear in that sense. So now we come to the part about real returns. So majority of the times the real returns are lower because of inflation. So now there are 3 most important questions which should, if you have an answer to it, you should stop listening to me going ahead. So will your salary increase or your business profits increase equivalent to the inflation forever? When I say forever is because the lifespan has increased. So lifespan is now closer to 60 to 70 years, maybe 80 years for a lot of people. So you have a very long time post your retirement as well, wherein you will not be earning any money. Will inflation go down in India? Now this is a very tricky part, tough to project. And the last one, will you get a lottery? If these 3 things, if you believe can happen, then there is no need to be into equities at all. Because your salary is increasing at a very massive rate of 20% CAGR for a really long period of time. So your savings will also increase at the same CAGR. So, which is not generally the case. I think if you ask yourself, even business profits or your earnings, then will you get a lottery? Now, this is totally a fluke. So, if you believe in that part, then maybe you can go ahead buy lotteries instead of equities. If you think any of that is not going to happen to you, you would need equity investment. How much as part of portfolio? Now that is a part wherein we go to individual risk assessment, and maybe for that I'm not the best guy to talk about. I think Manish and Nandish are the best people to actually do an individual planning. So if you believe these three things are not clear, then we can go to the part about equity markets. Now, the major problem is on the face of it, equity markets are scary. Scary to the point, say for in the last, say 1 month, 1 to 2 months, we've lost almost 25% from the peak. In many stocks, on an index basis, we've lost 10 to 12%. And in the last 1 year, we are down 25% on the benchmarks. Then, now this is just one part of the market, which I believe is a correction. But what happens in bear markets, which is the real crazy part, and it scares majority of the investors, is in severe bear markets in India, Nifty and Sensex have dropped by 55 to 60%. Now that is losing out 55 to 60% of capital if you have bought right at the top. And there are generally a bunch of people who do that. So 2007 was a classic example. We had the maximum inflow in mutual funds and a lot of retail interest. Then the next sorry part is a lot of story stocks which move up in such bull markets tend to fall by 90 to 99%, leading to a total capital erosion. And these are generally stocks which are covered a lot by the media and people around. There's a lot of talk, a lot of buzz around it. So for example, DLF, Unitech, Suzlon. Now, these three companies were part of the Nifty at one point of time. So Unitech was in the top 20 in the end of December 2007. Even Suzlon was part of it. Then maybe there was a name RNRL and many other companies which have gone down by 90 to 99%. This is the scary part, which makes direct equities investment risky for people, those who have not done their homework. Then we come to the scary part again, because this is not digestible. In bull markets, Nifty Sensex go up by 3 to 8 times. This has happened many a times, and stocks go 10 to 100x. And this has been the case in many bull markets. So even in the last 2-3 years, we've seen a lot of stocks go up by 10x. A normal stock has, say, an average random portfolio has done a return of 100% plus in the last 2-3 years. But a 10x does not excite as much psychologically. Okay, at times you may get stuck at the slides, so do not worry. It will be a little lag at the problem. So it will generally going up. It will just catch up in a few seconds. So just be patient. I think the audio would be very clear. So focus on what I'm talking about, and that should be easy. So the scary part is markets falling 50%, and in bull markets going up by 3x to 5x. But this does not make you happy, because there is a big social, psychological reasoning to it. A loss is much more painful than a gain, an equivalent gain. So it is the downside which scares everyone as people enter when there is euphoria. So for example, I'll be very blunt to say this. If this webinar was done at 9,000 Nifty, we would have 3x the people than today. And this has been the case. So we generally get more people talking about markets when the markets are rising, participating when the markets are rising. So nobody likes temporary loss for long-term gain. So if you want long-term gain, you have to stay long. So let us go to what happens in the bear markets. This is an example post Harshad Mehta. The drop was of 55% and remained sideways for the next 8 to 10 years. So entire generation of investors got out of the markets. So if I were to talk to my dad, he will talk about how people lost their pants in Harshad Mehta times. Then again, so that was Harshad Mehta drop. So we fell on a Sensex from 4,500 to 2,000. And there were no great returns for the next 8 to 10 years. Then came the IT boom, which is said to be Ketan Parekh K10 stocks. Again, there was a fall of 55 to 60% in a year. Then we come to the next part, the 2008 financial crisis across the world. Again, indices fell by 55 to 60%. And nobody remembers the fact that the Sensex started from 3,000 to 6,000 levels in 2003 to 4. Even after the correction, it was at 8,000, which is also a superb return. But everyone remembers the downside part of it. Now, this is a 35-year log chart, which is on percentage basis. So I would pause on this to let people see how on a percentage basis, on a longer term, the trend always looks up. Now, this is a 35-year chart. So even if you were to look at the last 20 years, the returns do match up in the next bull cycle. So I'll let this chart be for say a few seconds so that everyone can see it. All right. So then I talk about corrections in a bull market as well. So maybe what scares people is the big fall once in 8-10 years. But the markets are always going to be choppy. So let us look at the corrections in 2005 to 2007, which nobody remembers. So we had 4 dips of more than 10%. In a span of 2 months in 2006, the index dropped by 30%. Now that is 30% in 2 months. Now we are looking at a dip of 25% over the last 1 year, which is scaring off people. So even in the raging bull market of 2005 to 7, we had a 30% dip in a span of 2 months. So this was about a brief about equities and the previous cycles. So to sum it up, the ride won't be easy, but neither is a job or a business which gives you money at the end of the year. So as we say, if you get ill, you search the right doctor and go to him. If you want to stay healthy, you walk or you go to the gym. But in equities, if you are coming for a thrill, you don't need anyone. If you are serious, find a good advisor, trainer, or learn it yourself. So these are the 3 options which you can take. So now we go to the part wherein we've seen what happens in equities. To sum it up, it is the big drops of 50 to 60%, which scares you off. The further drops even in a bull market of 25 to 30%, which again scares you off. The worst part being when you buy story stocks, they can drop by 90%. But over the long term, this all seem to be just corrections and opportunities in hindsight. I believe the current correction is again an opportunity which could be in hindsight. So now we come to the longer term part, calculations. So we will take questions at the end of it. So do not worry, I'll take as many questions which is possible. And apart from that, also you can connect with me offline. Okay, so the general assumption has been, so I'll go back to the assumption of 17% CAGR for 35 years. Now this is I can say very confidently say you will not get such a CAGR for the next decade. So, but even NSE says so. So this is how even the exchanges tend to push the idea of buying equities right at the top. So this was somewhere in 2014, wherein even NSE and investors in interest came out with this advertisement about the Nifty ETF giving 16% CAGR in 10 years. So this has been the core belief. A lot of financial advisors today, those who really don't understand the concept of compounding really well and how should returns be made and what should be the return about the GDP growth rate or say the growth rate or the fixed return yield, tend to pitch a lot of equity products as 16 to 18% CAGR would be made over the next 10, 20, 30 years and come out with rosy Excel sheets. So this has been, so let us see what is the real CAGR return for the next 10 years. What is the real CAGR return? So what I say,
Guys, keep patience. We are reconnecting. Just wait for 2 to 3 minutes. We are reconnecting. Don't worry, everything is fine. Just wait
I
for
just
two, three
got
minutes.
disconnected. Yeah, I just got disconnected. So I just got disconnected. So what I'll do is very quickly. Now these are the numbers on the chat. Just people, can you take it? What could be the CAGR? So now this is the data over the last 20 years. Over the last 20 years, where was the market, say, in 1996? So the numbers are, so I'll just put it for Nifty. We've gone up from 1,000 to 7,000. So what do you think would the CAGRs be? So very quickly, you can put it up on chat. All right. So now the 20-year CAGR. So we started at 1,000 Nifty roughly in 1996 and are at say 7,100. in 2016. All right. So what do you get is the CAGR today for the last 20 years. So generally people say equities give a return of 15% right over long term. 20 years is long enough. Now everyone in the market keeps talking about, all financial planners, market gurus, books say so. Now this is the last 20-year CAGR. So the CAGR is 10%. Also, the last 10-year CAGR is only 9%. So if you really look at it, this is how the real numbers are. And this tells you the current scenario. 10% CAGR for the last 20 years. You can take various start and end points. It just does not go about a very long CAGR. So this is the fact. Now, then how does 16 to 17% CAGR come up on Sensex? So there is one part of the data which a lot of AMCs or guys will not really talk about is Sensex came up in somewhere in 1986, but the data is from 1979. And what happened is, in the bull market of 1990, in 4 years from 1988 to 1992, Sensex went up 11 times. So were exchanges accessible to all investors in India in the early 80s? No. How many mutual funds were present? Zero private mutual funds in the 1988 to 1992. How many companies? So majority of the times you see this presentation as to what 10,000 rupees would have made if you would have bought Infosys in 1988, Wipro, Dr. Reddy's, and a list of stocks, which 10,000 rupees has become 300 crores, 10 crores, 20 crores, 100 crores. So this has been the selling point of how only money can be made and there is no homework needed. So the fact is, majority of the 16-17% returns is distorted by the 11 times move up in 4 years in 1988 to 1992. Post that, the returns have been very normal. So this link, I'll be sharing the presentation with everyone. So this is a bit more detail which Money Life in one of their articles has covered. So wherein your CAGR is roughly around 10 to 12%. So then I come to the fact as to why current market scenarios are a good entry point. All right. So, okay, Kothari Pioneer was there as private mutual fund by 1986. So I'll put one more point to it. Since 1990, only 5,000 investors continue to sustain this 20-year period. There were many name changes to the Kothari. Okay. So what I say is, generally, statistically, over the period of time, whenever the CAGR is good, we see a lot of discussion across is all right. So generally, most of the times, what happens is people start allocating to equities when the returns have been great and stop when the returns go down. So 2007, we saw a lot of NFOs. I would suggest people to, there would be a lag on both the ends. I'll be sharing the presentation later on with everyone. As of now, if we share it, it will take a lot of time. So most of the talking is I'm talking about the stuff which is already shared on the presentation. So let me come to the point, which is the most important point as we end this part of the presentation. Is most of the times people tend to avoid equities when the CAGR returns have actually come down to a point of 8, 9, 10% over a period of time. So there was a big period between 1997 to 2003 wherein the returns were negative for that almost a decade, or even 1994 to 2003, and that is where there was a lack of interest. 2007 there was 2007 there was a lot of interest all through. So as of today, if you look at the numbers statistically on various time frames, whether you take 5-year return, you take 10-year return, you take 20-year returns, the CAGR does not beat fixed returns in many of the cases. So as of today, even a bond fund manager has come out with an article saying bond returns have been better than equity returns in 21 years. So this has been the only time when there is a statistic to actually pitch in bonds against equities over a long period of time. So what I see is when your 10-year CAGR return, when your 20-year CAGR return is at the lower end, that is the best time to buy into equities. So let me go to the next part. So the next part is, okay, all right, boss. We have been investing in SIPs, we have been investing consistently for a long time, and still the returns are bad. So let us go to the timing part of it. So what could be the best times you could have bought equities? Is my video audible to everyone? Is the audio, is my voice clear for everyone? Okay. I would suggest people not to talk a lot on the chat because I'm not able to go through it, only if the audio is not clear. So many a times the audio is not clear because of the internet connections, because a lot of people are connected on this. All right. And only about and consistent investing. So let us get to the part of timing. So for example, the best times to buy markets would be when markets have fallen after a big bear market. So I just randomly take a point. So for example, the lowest point of 1993 after Meta scam, suppose you would have allocated your total money around that point. Then the next worst part was when we had the bear market in 2008. So Sensex was roughly around 8,500 on that day, which is the day Lemon collapse happened. Okay, so let us see what could the returns be during this period. So think would be that you would have bought on the bottom of Harshad Mehta or on the bottom of financial crisis in 2008. Now this is roughly 12 years period. The other one is say roughly 20 to 23 years. So can everyone take a guess as to how much would the returns be? So what I'll do is I'll put it up on the chat also for everyone. Sensex equal to 100 in 1993 if you would have bought. Sensex equal to 8,500 in 2008. So what could be your CAGR returns till today? In the meantime, I'll just disconnect for a second and reconnect so their speed is good. Okay. Now, can you all hear me? So somebody said 45% also. That's very obscenely off the mark. Okay. So there are some people having good calculations on the record. So even if you were absolutely right in finding the bottom and date, the exact date being the day of lemon collapse. So I'm not saying you can identify the bottom. All I'm saying is even if you're exactly right, let us see what the returns were. Now, if you notice the fact, nothing comes to CAGR of 20%, sir. Nothing comes to the 16% number which has been promised. So I'm not talking about even finding the bottom. So this is what is the statistical case today. Even if you were making the bottom, if you could get the bottoms right in 1993 or in 2008, your CAGR return would only be 12.7%. So this is what tells you as of today where the markets are placed. Wherever, if you're the best investor who could exactly time the bottom, which nobody can unless he is lying, your returns would not go to the 15-16% part. So if you see on the screen, even finding the bottom right exactly in 2008, your CAGR today would just be 12.7%. So lemon crisis or Harshad Mehta bottom, this is what your CAGR would be. So if you believe equity returns would be great over the next few years, this is the best time to be in. So what I believe is, okay, why ignore dividend of 1.5%? We tend to ignore dividends because there is a cost of readjusting to Nifty as well as the brokerage as well as the expense if you take mutual funds. So what what is the conclusion out of this point is, even if you are right on the timing part to the T, your returns would be closer to 11-12%. So that is how bad the markets have been for the last few years. And there has to be a very good mean reversion over the next 5 years or maybe over the next 2 to 3 years as well. What I believe is the best time to start allocating more to equities. So this is the conclusion. So now I'm just taking a very quick slide. Is suppose even if we have to take, say, what could the markets be in 2020, say a 10% CAGR for 20 years, the market should be at 38,500. Just taking some random stand-up points on round figures. 12% CAGR for 20 years, you should be at 55,000. Even on a 10-year CAGR basis, if you have to make just 10 years, 10% CAGR for a 10-year time frame, you should be at 40,000 plus. So what I mean to say is, currently you are standing at a point where even if over the next few years, even to get to a mean reversion of 10% returns or 12% returns over a 10, 20, 30-year period, you'll have a solid return over the next 3 to 5 years. So then we come on to the part of timing it wrong. So if you were to time it wrong, so why it is necessary to time it right or maybe do a SIP is because if you put it totally wrong, if you have put your money at 21,000 in 2007 to 8, even if it goes to 47,000 by 2020, your CAGR would just be 7%. So this is what ends up if you time it wrong. So as of today, what I believe is over the next 3 to 5 years or 7 to 8 years, the amount of returns to be made would be much, much higher than what you would expect the 20-year CAGR to be also. Because statistically, CAGR returns have been bad for the last so many years. The CAGR are bad even on a very short-term rates. Also, the return expectations should be lower because we are now shifting from say in the 1990s, your G6 were between 11 to 16%. Today, your G6 would be ranging between 6 to 9%. So generally, we should expect around 4 to 5% max above the fixed yield. So our returns should be closer to 12 to 14%, or rather closer to 12% plus minus 2% over the next 5 or 10 years. But if you start buying today, I believe your returns would be much, much better than the usual returns. So majority of the people are actually able to go through the audio and video. It could be a net connection problem. Now we come to the very quick part of looking at the current scenario, and a very important part is a lot of times people have talked about the 8-year cycle wherein markets are able to have fallen significantly in the period of 1992, 2000, 2008. So maybe in 2016 also markets will fall by 50%. So we go about the difference between the current market today and was in 2007. We've not seen a broad-based run. Neither has there been a sectoral craziness wherein some sector has gone up by 100x. For example, in 2007, Unitech went up 100x to 1000x. DLF went up crazily. A lot of real estate stocks went up crazily. In Ketan Parekh, we had IT stocks go up 100x. In Harshad Mehta, we saw a massive run in a lot of cement companies. So what I believe is this could be a 8-year cycle of fraud. So maybe some corporate or individual will go to jail over the next few months. That is the only dumb prediction or useless prediction which can be made. Now, why I believe is we'll not see a major fall in the next few years is, so just give me 10-15 minutes, we'll end the presentation and we'll go to the final question and answer session where we'll take. So let me go back to the fact as to why investing when the CAGR returns are low is the best time. Let me give you an example. In 2007, I've read many reports by asset management companies and individuals, financial planners talking about a 25% CAGR return by equities. And that was the selling point. So even a 60-year-old was sold ULIPs. Even a 20-year-old was sold ULIPs with a 25% projection. Now today, a couple of years back, whenever the market start growing, now we start using 17%. As of today, when your CAGR is only 9-10% is where you get maximum returns over the next few years, better than the normal CAGR returns. This was one of the contentions when we spoke about a similar scenario happening in 2013-14. In 2013-14, we were similarly placed at 8-9% CAGR returns, and we got a good mean reversion over the next 2 years. So we've got decent returns. I believe over the next few years, we'll get a strong return over the next 3 to 5 years. One more reason why Nifty today is well placed than it was in previous cycles is in 2007, RCOM was at 4% above L&T, Infosys, TCS, HDFC, ITC, and HDFC Bank. So the weightage of RCOM was 4%, whereas HDFC Bank was 1.87%. Flashback to 2015-16, we have HDFC Bank at 7.5% instead of ONGC and Reliance. So as of today, the whole structure of Nifty is much better in terms of quality, in terms of depending on the government. So we have lesser PSUs in the top 20 stocks. We have companies with much more lesser debt than that was in 2007, lesser commodity companies, lesser investment linked companies. So these are some facts. There is a whole article on this part, wherein the shift today is your top four weights are Infosys, HDFC Bank, HDFC, and ITC. Now, these are, so I would not be calling ITC as a very well-run company, but the top three companies are very well-run, and they definitely are not story stocks which can go down desperately over the next few years. So we have a strong composition of the markets today, and that is why you may not get larger dips as people expect. Then we come to the part of why today is a good time. So this is a earnings projection by analysts on Bloomberg. So earnings were downgraded max in 2009. In 2009, not in 2008, by almost 40%. The earnings estimates dropped when the markets had already fallen by 56%. Flashback to 2016. In 2014-15, we had earnings estimates of 20% earnings growth, 15% earnings growth for the next few years. So this has been the sharpest downgrade by analysts. And whenever there has been a sharp downgrade by analysts, is a contrarian buy call, and that is where good returns have been made. Now, this is just a quick technical check on how the markets are placed today. Very similar to 2011. We'll take questions after 10 minutes, so give me 10 more minutes. I hope the audio is clear. Is the audio clear for everyone? So I think it would be there for a majority of the people. The audio would be very clear. Great. So what I'm talking about is, if we look at the chart currently, the correction in 2015 is very similar to the correction in 2011. In 2011, markets fell by 25 to 30% in a period of 12 to 14 months. In the period of 2015, we've fallen 25% in the last 1 year, very similarly. As of today, there are a lot of concerns about how global markets are in a recession. There is a China problem, there is a Brazil problem, there is n number of problems which are discussed today. Similarly, if you were to go flashback to 2011, we had a problem called pigs. Then a new I got added to it. So it was Portugal, Iceland, Ireland, Greece, Spain, etc., which was discussed. That time the Nifty was 4,500. It ended up at 5,600 over the next 2 months in January 2012. And we have grown over the last 3 years, from 5 years from that point. As of today, we have a lot of discussions on how there is a problem of growth, how there is a problem of GDP numbers, how there is a problem of China, how there is a problem of Fed. We had a Fed problem in 2011 as well as in 2013. So in 2013, US dollar to INR went up to 68 plus. There was a QE problem. The markets were at 5,500 to 5,100. So when there are problems, so you never get a good price and a good economic scenario. This is the real fact about markets. So you get a good price when there are concerns. So in 2013, if you would have bought at 5,500, you had a return of more than 50% over the next 2 years. On the index implies much more returns on a portfolio basis on mutual funds and direct equities. So as of today, we've had a 12 to 14 months. We have had a 1 year correction. We are down 25%. Whether we'll fall more or not is always going to be tough to predict. But at current levels, your risk reward is very exciting. So I believe if there is any incremental positive news, this markets could surprise very similar to 2011. So this is where we are. We've made new bottoms over the last 10 to 12 months. And I believe this is the best time to buy, because this is what happens when things change. So we had a correction from Diwali 2010, where we went back to 21,000 Sensex levels or 6,300 Sensex levels of 2007-8. For the next 1 year, we fell, and there was a massive rally of 20% on the index in a period of January 2012, purely on two words called green shoots. Then we had a correction, and by end of the year, we were up 30%. Even global markets like Dow Jones, Germany's DAX, which was supposed to be a biggest problem area, Europe, went up by 5,000 to 7,500, a return of 50%. So that is the kind of return is made when there is a lot of negativity around. So this is an example of what happened in 2011. The first chart is Dow Jones, which is in blue. I'll keep it for some time on the screen so there is no lag. The red one is Nifty. So in 2011, US markets bottomed in October 2011. So did the markets in Europe and various other countries. But Indian markets bottomed in December 2011 at 4,500. Over the next 1 year, even with volatility, sharp drops, we ended up the year with a return of 25 to 30% on both the indices. So that is what we were shaping up in 2011. A lot of economic concerns, a lot of talk, but the returns were great. Now we look at the current scenario. We've seen a good drop in our markets in the last 2 months, similar to the Dow Jones fall. So Dow Jones has fallen from 17,800, 18,000 to roughly 16,000 levels. We've fallen from 8,000 to 7,000 roughly over the last few months. We've made new lows. So Dow Jones has already bounced back, but we are still making new lows. So I believe this could also be a case similar to 2011, wherein global markets also rally up post a lot of negativity around, and then we play catch up. So downsides from here could be not very large, time to accumulate. This is a bit of a technical chart. On Nifty, we are at the lower end of the trading channel. We made a low somewhere around 6,900. And our all-time highs in 2007-8 were at 6,400 roughly, which could be a very strong support even if I have to be negative. So that tells me the downside risk even in bad times is 10%. Then another technical parameter, we've generally seen a lot of support around the 200 weekly moving average over the years, even in 2004. And the only time we did not see it work was in 2008. But in the last 10 years, this zone has been a good time to start buying. Then a few data points just to jazz it up a bit. So the net short positions in US have hit, say, the lowest positions, as in the net futures holding position is at the lowest. There is absolutely no interest. The last time it did so was in 2011. And that is when we saw the markets bottoming out. So we are also reaching the same points in 2016. Then another data point is the dividend yield of S&P 500 to the treasury yield. So as of today, roughly the difference is 50 to 60 basis points. So S&P 500 yield would be around 2.5 to 2.7%, and treasury yields would be at 1.75 to 1.85%. So whenever this has happened over the last 5 years, to generally does not come to such differential in the last many years, but this has been the zone of bottoming out in the last 5 years. So last it happened was in somewhere in 2011 and 12, and we got good returns over in US markets as well. Then we take a quick take on Nifty PE. So a lot of mutual funds have a dynamic fund also, as well as say a scale on where one should buy. So roughly the expectation of analysts, so I have no expectations on the numbers. I'm not capable of calculating it, but even the trailing numbers are at closer to 380 to 390 for the last 12 months. The estimates are 400 to 420 for FY16. FY17 estimates are a bit too overfetched, looks overfetched as of now, even after the downgrades at 460 to 500. Generally, a good PE to buy has been 14 to 17 times trailing. So that gives you a range of 5750 to 7000. And we've generally not gone below 12 to 14 unless it has been a bear market preceded by a crazy bull market. So we haven't had a crazy bull market, so I doubt we'll go to 10 12 PE levels. So I believe this is the zone. One more point is, we are, unlike 2007 or in 2000 or in 1992, our margins today on the top 50 companies or the top 500 companies are at 20-year lows, unlike what was the case in 2007, when even Tata Steel had a ROE of almost 30 to 40%. So that was the kind of margins which we were standing at 2007. We were at peak margins, but in 2016 we are actually at the bottom margins and maybe digging much more lower. So things can only get better over the next 5 years, then go worse. With a 25% drop from top and coming into decent multiples, this is a value area. We are back to Modi prices. So during elections, we were at 7,100 on the date of election results. We also have crude at 30. So if you would have asked me where would Nifty be 2 years back, if you would have asked me the question, and where would Nifty be if crude was at $30, I would have given you an insane number. Luckily, no one asked me that question, so I haven't made a blunder about it. So a lot of things are back to favorable. So this is where we are. Then finally, I'll try to not take this discussion very deep. I'll just skip it to one single slide. Okay, we find Nifty, we find growth concerns, we find it is low growth, the margins are not good, but we feel very safe in real estate. So as of today, it is very difficult for me to sell equities even at 14 to 18 times. Okay. So I find it very difficult to sell people to buy, as in to sell the idea of buying equities at a 14 to 18 PE levels. But real estate can be sold much more easily without looking into any numbers. So I'll just take an example of a 2 BHK at 2 crores in Mumbai. Given that I'm from Mumbai, I'll try to speak on that. Monthly rent at 50,000. Annual rent of 6 lakhs. It could be lesser also actually as of today. The only reason people go for is, so if this is your second home, there is a lot of maintenance, tenants, brokerage, and so on. But even if it is your owned flat, there would be, without looking into the emotional and social value attached to it, this is the P multiple. So it's a 2 crore flat without taking any maintenance expense, renovational expense, parking fees, etc. Your returns in terms of rents would be 6 lakhs. So that's a earning of 6 lakhs on a 2 crore. So the price to earnings ratio would be 33 times. So many a times people say, as of today, people say when there is no growth in Nifty, why should Nifty be at 15 times or 18 times? So in the same way, I can ask, why should real estate be at 33 times? So that is much more easier to answer. It should not be, but that is how markets are always. So I won't say real estate is good or bad, but you definitely need diversification. So then compounding and real estate myths. So there are some people who believe real estate doubles in 3 years, some in 5 years, some in 7 years. But the magic of real estate returns is not in the real estate prices, but in the leveraging by loans. So one simple number on compounding, if you believe real estate doubles in 3 years, your 2 crore flat would be worth 200 crores in 20 years or 20 crores in the next 10 years. If you believe it doubles in 5 years, it would be worth 8 crores in the next 10 years and 32 crores in the next 20 years. I think this will actually make you laugh on your real estate assumptions. So do you think that sort of return would be made in real estate, 15% CAGR? I don't think so. I'll not go to the negative part of it. But this is where you are placed in. So will your real estate grow at 15% CAGR and 20% CAGR, or it can go down by 20% over the next few years, which is a very possible scenario. But your home loan will remain at 8 to 10%. Will your income grow at 15 to 25%? Very difficult. Even FD returns may not remain at, say, this line is from the 2 years back, 9 to 10%. I think it's come down to 8.5% today. Can it go down to 4 to 7% in the next 5-10 years? Very much possible. Equities have large drawdowns, but they do have large upsides. Do all your assets have similar risk rewards? I don't think so. So you need to think about your equity exposure. I would suggest to increase it at current times. So if you want to prosper in equities, think not of what you can do in the next 1 month or the next 1 year or the next 2 years, but in the next 10 years. So the best way to do it is learn fundamentals, technicals, and above all, common sense and statistics. So I'll end the presentation is, in equities now, it does not matter how much returns you make, but what will matter is what is the percentage of equities in your net worth. So I get a lot of clients who have 5 lakhs to 25 lakhs or 5 crores to 25 crores into equities, and that goes down by 20%. They find it bad, but they have a net worth of 20 times their equity exposure or 50 times their equity exposure, but have a huge amount of money in current and savings account. Like Nandish says, it's a crime to have a lot of money in your current and savings account. We believe over the next 3, 6, 12 months, investors should increase conviction and allocate more funds. My personal view is at current levels and over the next 3 to 6 months itself is an extremely interesting time to put a lot of money into equities. So increase allocation to equities. So I would not go to stocks I like. So there is, the last part is, when there is a bull market, your selection does not really matter. What matters is your portfolio allocation. So if you have 2% of your net worth into equities, even if it goes up by 5 times, it does not change your net returns. But if you have 50% of your 30% of your net worth, it will make a big difference. So that is where I end my presentation. Now we can take questions to end of it. So now we can go to the questions part. So let us take one by one. Sensex is the only sample shares. Does the mid and small cap mutual fund right choice to 16 to 18%? So mutual funds, if you buy large caps, your downticks would be lower as well as your upticks. Same is the case with mid caps and small caps. Your downticks will be bigger. So on a sharp ratio basis, both end up with the same sort of returns. So let us take one by one. What's the best option to invest lump sum amount, say 1 lakh to 5 lakhs? So if one was to decide what sort of funds to buy, etc., that is something which I'm not really capable of. So if you want the best funds, etc., and given that I have to interact with a lot of fund managers, I would not recommend any. But I think Manish and Nandish would be better in that part of the subject. If I make 5% return every month, then how to calculate CAGR for 1 year on my return of 5% per month? I think Shrikant, I would like to give my money to you if you can make 5% every month consistently. So maybe you can contact me offline, because I think that is not sustainable for a long time.
Nooresh, can
So I
we,
believe it's
Nooresh,
the right time to invest into stocks. There is another question about QE uneasing in US. Will it impact India now from current levels? So that's a very difficult call to take, but that is where people love to talk about. So macroeconomics is a lovely cocktail or a tea discussion, but it does not help in investing.
Nooresh, there is a
How about investing
question
in
that
Nifty Bs? I find Nifty Bs and Junior Bs to be good scenarios, but I think some index mutual funds would be better because of the illiquidity in the same.
Nooresh, there is a question if we are in a bear market right now. Can you
Thanks
answer
for
that?
this. I've heard about this, that you cannot expect more than 10% from markets. The return from markets is dependent on the growth rate as well as the fixed return. So as of today, when we are getting towards the 6 to 8% time frames, returns should be closer to 12%. What is P? P is price to earnings, and CAGR is compounded annual growth rate. What to target now, large, mid cap, or small cap sector? I would say be diversified, because in mid caps you have to do a lot of homework and be ready for the risks involved. So I'm a mid cap guy. I would say buy mid caps, but we do a lot of homework and still go wrong many a times. How can we achieve monthly income from equity investments? There's no way where a consistent monthly income can be made. Is it wise to invest in oil stocks? I would say go diversified unless there is a lot of homework done, whether you've gone to the fundamentals of each oil company. Why you didn't talk about the stock you like? I would not like to recommend stocks wherein I would not be able to explain the risks involved. Should I book profits in mutual funds once they have given 15% CAGR? It's not about a CAGR return, etc. So there is a good, whenever the Nifty PE goes about 22 is where you can start booking profits, has been the case, which has worked. If CAGR is 10 to 12% over long run, why should I take risk of investing in equities? So I believe it would be 10 to 12% over the next 10 years, because your bond returns will go down in a big way. So maybe what you have deployed today at 9% will give you 9%, but incrementally you may not be able to deploy at 9%. And I'm saying this 10 to 12% is the minimum case. There have been crazier times also. So there could be times, if you time the exits in a bit of systematic withdrawal, your returns could be more than 12%. So maybe if you buy it today, maybe your returns would be more than 12% is my expectation. So can you please tell me on the bottom level? So it's very tough to predict bottoms and tops, but yes, I would say my belief is according to my position, I'm 100% invested. So I hope there is it's a bottom very close by. So can Mr. Nooresh offer discounted rates for training and personalized services? So we haven't thought about anything like that. This was just a presentation, a webinar to pass on the view. So now I'll take the recent questions.
Nooresh, can you listen to me?
So
Nooresh, can you listen to me?
I'll say just pause for a minute before I'll say just stop before I can take a few questions. So we'll stop it here. Let me answer the questions which have already come up. So let me take the few questions from the bottom. Should lump sum be invested in stocks or mutual funds or real estate? I would say from current levels, you should, if you cannot do lump sum, you should increase your SIP value. So I will not take stock specific questions. If you want it, maybe you can ask me offline. So what I'm saying is, as of today, the current CAGR is 10-12%. But if you would have taken it, say maybe a year back, it would have been at 15%. So I'm saying when the CAGR returns are at the lowest, is the time to buy. Rather than taking it as a conclusion, the returns would be 10-12%. CAGR does not take into account inflation or any other data. So I don't say book profit in MF. I would say this is the time to buy MFs and equities. So as of today, the CAGR looks good. Maybe 2 years later, the CAGR will look very promising. So my view is today is a good time to do lump sum and increase SIP. What is average CAGR return for FDs? So it keeps on varying according to the FD returns. But if you realize one big difference which everyone misses out is on FD, it is taxable. So even if the return is 9%, it ends up at 6 to 7%. So you have to take the tax-free return. So equities is FD, equities is tax-free on the long term. So are we in a bear market now? Yes, we have been in a bear market. So, and bear markets are the best times to buy into equities. So I don't have a target for Sensex over the next 1 year, but I believe this is a good time. I have no idea about what the budget would be. So I think if there are any other questions, you can mail it to me. I think this should be enough for the day.
Yeah.
Mutual fund sites show return as 20-25%. That is what has happened in the past, but past is not the guarantee of future. So what happens is majority of the times you see returns of the past and you buy. But as of today, this is where we are. I don't think so. LTCG will be changed. Even if it is changed, it does not make a difference. It would be a good strategy also. So the ideal exit strategy is basically like, say, for example, as of today, buy at 14 to 16 multiples, exit at 22 to 25 multiples of Nifty. This has been one of the best strategies. So maybe about 20p multiple, you reduce your SIPs, and below 16, 17, 18 multiple, increase your SIPs. If LTCG is taxed, then the return will be less. Even if it is changed, it would just be a timeline change from 1 year to 3 year. So it's just going to be a timeline change. If you are going to be for more than 3 years, there will be no tax. We'll be sending the PowerPoint presentation to everyone. And I think maybe we'll check also the recording if it is good enough. So that will also be shared. So maybe this was the first time, so there were a lot of issues. So the next time, whenever Manish does a presentation, it would be much more interesting. Even I'll be participating in all the other places, and I would like to learn from other speakers going ahead. So thanks a lot, everyone. If you have specific questions, my contact details are given. So I cannot talk about specific stocks. Maybe on the sector side, I like textiles and chemicals and even autos today. There is no suggested allocation between equity real estate goal. It has to be according to personal goals and personal risk appetites. I believe this is the right time to increase SIPs, not just start. So that is where we end the session. If there is any other query, I would suggest you take it offline personally, because this is a Sunday morning. Everyone would like to go back to their weekend. So we've already taken 1.5 hours of your time. So my bet as of now is on textiles, chemicals, and auto. There would be many bets which we keep changing also. So that's why I don't recommend stocks, because we do a lot of homework, and when we go wrong, we exit also. So everyone will tell you the entries, not the exits. So thanks a lot, everyone. Maybe this was a good try. Next time it would be better. And with Manish and this, I can assure it only gets better. They're very hardworking people, unlike me.
Okay. Nooresh, can you pass it to me now?
How many stocks one should buy? Last question for the day. It depends on individuals. I have a 20 to 30 stock portfolio. Some are fine with 5 also and 55 also.
Hello.
Thanks a lot, everyone. And say
Hey,
anything if you would like to ask. I'm accessible on email most of the times.
hey Nooresh, can you pass it to me now? Nooresh, can you pass it to me now? Guys, can you listen to me now? Hey guys, can you listen to me? Nooresh, are you able to listen to me? Hello. Okay. So I think, hello everyone. So this is Manish here now. Nooresh has completed his presentation. I hope you had some great learnings today. And I would like to thank Nooresh for taking up this webinar. It was an excellent session. Now, at this point of time, I would like to again share that this webinar was part of our JagoInvestor School initiative, which we had launched a few days back. Now we want to do these kind of webinars from time to time on various topics. Like we started from the equities. This was one of the first session. We'll take up more sessions. We'll do it on real estate. We'll do it on insurance. We'll do it on health insurance. We'll bring more people, more guest speakers for different kind of sessions. So most of the webinars we are going to do in future are going to be only for school members. Once in a while, we might open it up for all the other JagoInvestor readers. Now, let me share a little bit about our JagoInvestor School. JagoInvestor School is our dream project. Me and Nandish have been working from last 1 year on this, and we want to provide a great learning environment to all investors and help them in shaping up their financial lives to the next level. So I would like to extend an invitation to everyone who is not yet part of JagoInvestor School to become a member of it. Go and have a look at it and become part of it. So if you see your screen, I am just displaying the page. If you see the chat section, you can see a button called as Learn More. You can just click on it, and you will go to the school page. You can read about it. In case you have any questions, we'll be happy to answer it to answer your questions. So I want to assure you that it's a very valuable program. The commitment is very low compared to the value you get, and we are going to do these kind of webinars, a lot of these. Like you can say we will start doing it one every week, or many more than that. So click on the button and go to that section. Now uh, I think so this webinar is now complete. There were some glitches, there were some issues, but please pardon that, because this was the first one, and it's very obvious that we can have these kind of problems. Okay, so I think that is all. I With this we complete this webinar, and once again I would like to thank Nooresh, and will work on more sessions with Nooresh. We'll talk to him, and we'll see that what kind of sessions we can do in future on stocks. We'll try to do some more, like for example a very focused session on, let's say, how we can pick the stocks. What are some 5 parameters we should look in a stock to choose it for a very long term investment, like 5 years or 10 years. So we'll work on these things, and we'll get back to you guys. So great. I would like to thank everyone who has attended this session. It's really commendable that you guys have come on a Sunday morning, and it's not a easy thing. I really want to thank you all, and want to appreciate you on this. So that is all. So thanks a lot. Let's see you again. That's all. Thank you, Nooresh. Thanks everyone else. Yeah. Bye guys. We are closing it now. Okay. Thanks a lot. Okay, Nooresh, we can close it now.
Yes, sir.